Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this section, we're going to dive into some top alternatives to VXUS and how they might offer different benefits for your portfolio. Let's check them out. Political and economic risks. Investing globally means putting your money in markets governed by different political environments and economic conditions. This is exciting but doesn't come without risks. Regions experiencing economic growth today could face challenges tomorrow. Political instability, unexpected regulatory changes, or sudden tariffs can hurt markets and, in turn, your investment. For example, emerging markets often promise high returns, but their economic systems might be less predictable. You should also consider the impact of geopolitical events, like elections or trade disputes, which can create market volatility. Don't let unexpected headlines catch you off guard. Research the regions the ETF covers and pay attention to current events. To reduce exposure to these risks, focus on broadly diversified ETFs. Funds that spread investments across multiple countries are generally less vulnerable to problems in any one region. Expense ratios and fees. Every ETF charges an annual expense ratio, a percentage of your investment to cover management and administrative costs. While international ETFs are generally cheaper than mutual funds, they might cost more than US-focused ETFs due to complexities like currency conversions and compliance with foreign regulations. Here's how to evaluate costs. Compare expense ratios across ETFs that offer similar exposure. Lower ratios mean more of your money stays invested. Look out for hidden trading fees, especially if you plan on buying and selling ETFs frequently. These can eat into your returns. Understand any additional charges, like taxes on foreign dividends, which ETFs may pass on to investors. Even small differences in expense ratios can significantly affect your long-term returns. Imagine two ETFs, one with a 0.10% expense ratio and another at 0.50%. Over 20 years, that difference adds up, particularly with compounded growth. ETF liquidity and tracking error. Liquidity and accuracy are important but often ignored when choosing an ETF. You should consider how easily you can buy or sell the fund and how closely it follows its benchmark index. Liquidity. ETFs with high daily trading volumes are easier to trade without impacting their price. Low volumes can lead to challenges, including wider bid-ask spreads, which increase your transaction costs. Tracking error. This measures how far an ETF's performance deviates from its index. Ideally, you want minimal tracking error since the goal is for the ETF to replicate the index as closely as possible. Selecting ETFs with solid liquidity and low tracking error ensures your investments operate more smoothly. It's like driving on a well-paved road versus hitting potholes. You move forward with fewer interruptions. By weighing these factors carefully, you'll better position yourself to choose international ETFs that align with your financial goals while managing potential risks. Each decision should feel like a calculated move, not a gamble. Spotlight on VXUS, a comprehensive look. Vanguard's Total International Stock ETF, VXUS, stands out for anyone looking to diversify their investment portfolio beyond US borders. This fund offers access to a vast range of international stocks, spanning both developed and emerging markets, making it a convenient choice for global exposure. In this section, we'll dive into what makes VXUS unique, how it has performed, its cost advantages, and who might find it a good fit for their financial goals. Overview and investment strategy. VXUS is designed to give investors broad access to the global equity market, excluding the United States. The ETF tracks the FTSE Global All-Cap ex-US Index, which covers thousands of stocks from nearly 50 countries. This includes companies from both developed markets such as Japan, the United Kingdom, and Canada, as well as emerging markets like China, Brazil, and India. The fund's goal is simple: to replicate the performance of the underlying index and deliver global diversification. Unlike a US-only fund, VXUS minimizes an investor's dependence on any single economy by spreading risk across international holdings. It achieves this diversification by representing different market sectors and regions, capturing companies of all sizes, large, mid, and small cap. Notable aspects of VXUS's strategy include broad international coverage across 7,800 plus stocks, significant weight toward global leaders like Nestlé, Toyota, and Samsung, exposure to fast-growing sectors, including technology and consumer goods in expanding markets. If you're looking for simplicity, VXUS provides a one-stop solution for international stock exposure, effectively balancing developed stability with emerging market growth. Performance history. When reviewing VXUS's performance, consistency and diversification are key highlights. While short-term returns can fluctuate due to market conditions, its long-term value lies in its role as a diversification tool. Returns. Historically, VXUS's returns have mirrored global economic growth trends. It tends to outperform during periods where international markets, particularly emerging economies, thrive. However, in years where US markets lead, VXUS may lag behind domestic-focused funds like VTI, Vanguard Total Stock Market ETF. Volatility. Because VXUS includes emerging markets, its prices can experience higher volatility than US-only funds. Political instability, currency movements, or trade policies in emerging economies can all influence performance. Still, this volatility is often balanced out by the stability of developed market holdings within the fund. For context, during favorable years for international markets, for example, periods of global recovery or a weaker US dollar, VXUS has delivered strong returns. On the other hand, its performance can lag when domestic markets strongly outperform or global uncertainty rises. Understanding these dynamics can help investors use VXUS as a complementary piece of a broader portfolio. Fee structure and expense ratio. One of VXUS's standout features is its low expense ratio, priced at just 0.11%. This means you pay only $11 annually for every $10,000 invested, an appealing rate compared to many other international ETFs and mutual funds. Lower fees directly translate to keeping more of your returns. Why does this matter? Costs add up over time, and even a small expense gap between funds can make a significant difference when compounded over years. VXUS's low expense ratio is particularly competitive given its extensive coverage of international markets, as global funds typically have higher costs due to added complexities like currency management and compliance with various regulations. Competitors like iShares Core MSCI Total International Stock ETF, VXUS, or Schwab International Equity ETF, SCHF, also offer attractive expense ratios, but VXUS often edges them out by offering broader market representation. For long-term investors looking to maximize returns while minimizing costs, VXUS's structure stands out as a no-brainer. Who should consider VXUS? Not every fund suits everyone, and VXUS shines particularly for a specific group of investors. It's ideal for long-term investors. If you're focused on steady, long-term growth and want global diversification, VXUS is a solid pick. Investors seeking simplicity. With VXUS, you don't need to pick individual stocks or worry about region-specific ETFs. This fund offers broad international exposure and one easy-to-manage investment. Diversifiers. Investors who already have US-based equities and want to add global exposure will benefit from VXUS's wide-ranging holdings. Alternatives to VXUS. While VXUS is a top contender in the world of international equity ETFs, it's worth exploring a few alternatives that might suit different investor needs. Here are some top competitors to consider. iShares Core MSCI Total International Stock ETF, VXUS. VXUS is similar to VXUS, offering exposure to large, mid, and small cap stocks across both developed and emerging markets. The main difference lies in the index it tracks, VXUS follows the MSCI All-Country World ex-USA Index, which includes fewer stocks than VXUS's FTSE Global All-Cap ex-US Index. It also tends to have slightly higher allocations to developed markets. VXUS's expense ratio is also low at 0.09%, making it an appealing choice for cost-conscious investors looking for broad global diversification. Schwab International Equity ETF, SCHF. SCHF is another low-cost option, with an expense ratio of 0.06%. It tracks the FTSE All-World ex-US Index, giving it a similar focus to VXUS and VXUS but with a different index. SCHF has a more substantial weight in European markets, which may appeal to investors who want exposure to that region. SPDR Portfolio Developed World ex-US ETF, SPDW. SPDW is a more specialized fund, focusing primarily on developed markets outside the US, including countries in Europe, Japan, and Australia. It's perfect for investors looking for exposure to stable economies and less concerned with emerging markets volatility. Emerging market-focused ETFs. For investors who want more specific exposure to emerging markets, options like the iShares MSCI Emerging Markets ETF, EEM, or Vanguard FTSE Emerging Markets ETF, VWO, can be excellent choices. These funds specifically target high-growth economies, offering higher risk but greater potential returns. Which ETF is the best for you? That depends on your investment goals and risk tolerance. By comparing these alternatives with VXUS, you can make a more informed decision based on the structure, fees, and market exposure that best suit your needs. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.